What is going on with the housing market? 2 weeks ago, Zillow released a disaster of a third quarter earnings report, showing them operating at a huge loss, and announced they'd be quitting the iBuyer game for good. Their stock has plummeted 40% since. Last week, Opendoor, another iBuyer, released their third quarter earnings report, also showing them operating at a loss, but their stock price immediately jumped 16%. In this video, we're digging into the numbers to understand what went wrong, what went right, what this says about the future of the US housing market, and what you should be paying attention to if you're keeping an eye out for a market crash. I'm Jon Schwartz, a realtor and real estate investor in Los Angeles, California, and this channel's focus is data-driven, fact-based analysis of the housing market and how you can hack it. If that sounds interesting, maybe hit that subscribe button down there. It's up to you, but... So firstly, Zillow and Opendoor are both iBuyers, which is a fancy term for a new kind of home flipper. Home flippers buy distressed homes, fix them up, and then sell them at a profit. And the thinking is, if technological powerhouses like Zillow and Opendoor can't do it, then the housing market must be in huge trouble. A lot of alarmist YouTube commentary along these lines came out last week, and it's ridiculous because it's dead wrong. For those who are interested in understanding what's actually happening, here's the explanation. First of all, iBuyers are not typical flippers. Let me demonstrate by showing you an amazing flip. This is 2157 Moreno Drive, for sale in the beautiful LA neighborhood of Silver Lake. 2157 Moreno Drive just went under contract after a multiple bidding situation. List price is $3.888 million, and I'm guessing the final sale price will be around 3.9, maybe even 4. The flippers of this property stand to make about $1 million in profit, and they deserve it. Here's why. The flippers bought this property about 20 months ago for $2 million, and that was bid up from the asking price of $1.5 million. At first blush, this appears to be just brazen speculating that happened to work out. But no. This was genius. We can see in the old listing photos that this home has a finished attic, livable but nothing fancy. It turns out that this attic wasn't finished with permits, meaning that the square footage isn't technically livable space. An appraiser would not take this square footage into account when valuing the property. So our very smart flippers took the time to pull city permits and properly renovate the attic into livable space, thereby adding 858 square feet to the official square footage of this home. In a neighborhood where price per square foot easily reaches $1,200, adding 858 square feet is $1 million move. Plus, they added a pool to the backyard and refinished everything, and voila. Just based on the average price per square foot from recent comps and the size of this home, we get a valuation of $3.64 million. Add the pool and the new finishes throughout, and honestly, $3.9 million is a pretty fair price. The flippers probably put close to $1 million into renovating the property and stand to profit about $1 million. This isn't speculation or opportunism or greed. It's just extremely smart and extremely profitable flipping. Now enter the iBuyer. So the common perception is that iBuyers are really smart. I mean, nobody has more market knowledge than Zillow. But iBuying is actually very dumb because it's using data in the aggregate. Zillow doesn't know any particulars about any particular property. For example, Zillow has no idea what houses in Silver Lake have finished but unpermitted attic space to exploit. What Zillow and Opendoor have is a lot of data in the aggregate. So they know the median and standard deviation of home prices, bedroom counts, bathroom counts, square footages, etc. of homes in a given area. And they use that data, instead of any first-hand knowledge, to drive their buying and pricing decisions. 2157 Moreno Drive would never be flipped by an iBuyer. No iBuyer is going to identify that attic, much less pull permits to have the square footage added to the assessor records, not to mention hold the property for 20 months while doing the reno. iBuyers are looking for homes that they can buy at 85 to 90 cents on the dollar, renovate minimally, and quickly put back on the market at median pricing. Add a few fees to seller and buyer along the way, and you have a tidy little business. Tech-heavy, razor-thin profit margins, and successful only at scale. iBuyers are the DoorDash of the real estate market. So to recap, flippers exploit intimate knowledge of neighborhoods and properties to make smart buys, execute crafty renovations, and turn big profits. iBuyers, on the other hand, are betting that executing quick, low-margin flips based on aggregate data can be profitable at scale. Let's see how that bet is going. Firstly, Zillow and Opendoor are both publicly traded companies, meaning their quarterly financial reports are public. Links to both companies' investor portals are in the description, so if you're interested, check out the numbers for yourself instead of listening to uninformed YouTube rants about the end of the US housing market as we know it.
Why would they do what they're doing right now? Because in my opinion, they know the housing market is going into the tank.
People, be a realist right now. This bubble is echoing exactly what the last bubble echoed.
Anyway, I digress. Let's take a look at Zillow Offers' quarterly earnings since before the pandemic. Zillow Offers is the iBuyer segment of the company. First in green, we have revenue. And as you can see, after slowing down right as the pandemic hit, Zillow Offers has succeeded in really scaling up its revenue, selling $1.18 billion of houses in the third quarter of 2021. Now in red, we have a metric called cost of revenue, which is the cost of the homes that Zillow sold each quarter. The margin gets quite tight in the throes of the pandemic, then opens up again, and then, uh-oh! In Q3 2021, Zillow's cost for homes exceeds its revenue from homes. Zillow may have sold $1.18 billion of houses, but those houses cost $1.4 billion. Oops. And this metric is getting the most attention because obviously you can't make money if your inventory costs more than you're selling it for. And Zillow admitted as much on their earnings call when they confessed to greater volatility than expected in forecasting pricing. Talk about an understatement. But I don't think this is the key metric. Here in orange, we have Zillow Offers operating expenses. This includes marketing, administration, tech, all the stuff that has to happen for the business to operate. And as you can see, operating expenses are going up. So not only is Zillow overpaying for homes, but the business is getting more expensive as it scales. Finally, these blue bars show net losses each quarter. And as you can see, Zillow was actually trending in a good direction until Q3 2021, when Zillow Offers registered a $406 million loss. That's a huge hit, especially given how insanely profitable Zillow's website is. The core business, the website, generated $480 million of revenue with a 27% profit margin in Q3 2021. I think Zillow just lost too much money as an iBuyer to keep going at it. They bet on scale and efficiency, and they lost. All right, now let's look at Opendoor. Here in green, we have Opendoor's revenue, which follows a similar story to Zillow's, a slowdown after the pandemic hit and then back up to reach scale. In fact, Opendoor is a much larger iBuyer than Zillow Offers. Opendoor sold $2.2 billion of houses in Q3 2021. Here in red is Opendoor's cost of revenue. Unlike Zillow, Opendoor has managed to keep a good margin. The $2.2 billion of homes sold in Q3 2021 cost just $2 billion to buy. Kudos, Opendoor. But even more encouraging is Opendoor's operating expenses in orange, which ticked up when the company really started to scale post-pandemic, but has since been on the decline. Finally, the blue bars show Opendoor's losses, which have been dropping since the beginning of the year. On $2.2 billion of revenue, Opendoor lost $56 million. The bet now is that on, say, $3 billion of revenue, Opendoor will be profitable. I'd say it's a fair bet. I mean, in Q3 2021, DoorDash generated about half the revenue and twice the losses, and they're not going anywhere. So what does this tale of two cities tell us about the future of the housing market? Well, practically nothing. Both companies probably benefited by heightened market appreciation over the last year, though it's worth noting that the market's rapid appreciation led Zillow to overpay for homes. If you're using aggregate data to price homes, and that data is moving faster than ever, that's not necessarily a benefit to an iBuyer. Here's the market metric you need to be paying attention to if you're keeping an eye out for a market crash. Supply. A recent study by Freddie Mac found that the US is short 3.8 million homes. The housing stock deficit has grown by 52% since 2018. And this is at a time when millennials, a cohort of 72 million, are reaching prime home buying age. Look, the run-up in pricing since the pandemic started has several causes, including the increased money supply, including extremely low interest rates, including the unprecedented amount of workers relocating. But the underpinning of all this is the fact that we don't have enough housing supply to satisfy demand. And according to Freddie Mac, this trend won't abate for the next 10 years. Understanding supply and demand in the housing market is fundamental to knowing where prices are headed and if a crash is looming. To learn more, check out this video. And for a smart idea about how to act in this new normal of the housing market, check out this video. Please like if you learned something and subscribe if you'd like to continue learning. I post every Tuesday. See you next week.